Okay. Sit down. I'm about to explain the entire stock market in the next 5 minutes, which the progress bar tells me is actually 7. Look, the hoodie doesn't lie. Am I qualified to do this? No. Do I have a hoodie that says confidently wrong on it? Also, yes, and I think that's more important. Let's go. Picture the 1600s. No electricity, no Wi-Fi, no index funds. Just some guys in the Netherlands with a lot of boats. The Dutch East India Company had hundreds of ships hauling spices, silk, porcelain, and gold, basically the entire luxury aisle of the world. Problem: boats are expensive. Ocean voyages don't run on vibes, they run on cash. So the company had an idea I respect deeply as a fellow enjoyer of other people's money. What if regular people funded our voyages, and if the ships came back full of stuff, we gave them part of the profit? They sold shares of ownership, and those shares could be traded between investors. Without meaning to, they helped create one of the world's earliest modern stock markets. 4 centuries later, we've got CNBC, business school degrees, and me, a cockroach, explaining it to you for free. Progress. So here's how this works today, and I promise I'm more than 60% sure about it. Say somebody starts a coffee company. Very original, very I discovered a market inefficiency at 2 a.m. Before going public, the company works with investment banks and pitches itself to large investors. Banks, funds, guys in worse suits than mine. Then it launches an IPO, an initial public offering. Its debut, its main character moment. That's when shares are sold to public investors for the first time. After trading begins, anyone, you, me, your uncle who keeps saying he's getting in early, can buy in. When you buy a stock, you own a tiny piece of that company. Congratulations, coffee company co-owner. Do you get free coffee? No. Do you get invited to board meetings? Also no. But spiritually, you're management. During the IPO, money from newly issued shares can help the company grow. Afterward, most trades happen between investors, so your money usually goes to whoever sold you the stock, not directly to the company. Now imagine the company grows, profits rise, and more investors want a piece. More buyers chasing the same shares can push the price higher. Great news if you already own some. Your tiny slice is now worth more than you paid. Some companies also pay shareholders cash just for owning the stock. That's called a dividend. Growth companies often reinvest their money instead. Big, established toothpaste and power plant companies are more likely to pay dividends. So stocks can make you money in 2 main ways. The price rises, or the company sends you cash. Although dividends are never guaranteed, because apparently nothing in finance is allowed to be simple. But it works in reverse too, and reverse is where the group chat goes silent. If investors think the company will perform badly, they start selling. More sellers than buyers can push the price down. Then the falling price makes even more people nervous, so they sell too. It's less, the company became worthless overnight, and more, everyone decided it was worth less at the exact same time. A rising market is called a bull market. A falling one is called a bear market. Bulls attack upward, bears swipe downward. I didn't make the rules, I just enforced them confidently.
So what moves prices day to day?
Profits, material costs, new technology, interest rates, bad press, a weird CEO statement, a new law reshaping an industry. And sometimes, an investor just wants money for something else. Vacation, new car, bailing out a cousin. It happens. History gives us the dramatic version. In 1929, speculation, borrowed money, and extreme confidence pushed prices beyond reality. When confidence collapsed, the crash became part of the larger disaster that led into the Great Depression. In 2008, a collapsing housing market and fragile financial system wiped out trillions in market value. Broad, diversified markets eventually recovered after both crises. But not every company survived, and investors who sold during the worst moments locked in losses, while those who could stay invested had the chance to participate in the recovery. Which is why smart investors don't put all their coffee money into one coffee company. They spread it across many businesses and industries. That's diversification. Because betting your entire financial future on one company is less investment strategy and more casino behavior with a spreadsheet. One easy way to diversify is through an index fund, one investment that gives you tiny pieces of many companies. The financial equivalent of not putting all your eggs, or my egg sacs, in one basket. And underneath all of this is the market's main character: expectations. Products matter, profits matter, earnings reports matter. But prices also reflect what investors think all of that means for the future. If people expect a company to grow, they may pay more for its shares. If that belief disappears, the price can fall, sometimes before the company's actual results even change. Fear becomes part of the reason. That's not a conspiracy, that's just a market made of humans. Which is why experts keep repeating the same boring advice. Stop trying to time the perfect moment. Stop panic selling because of one bad Tuesday. For most people, long-term diversified investing is more practical than trying to outsmart the market's mood swings. Even though outsmart the market is extremely my whole personality. I'd love to tell you I have a secret system. I don't. Nobody fully does. That's the actual secret. And here's the good news. You don't need a fortune or a trading floor anymore. Anyone with a phone and a brokerage account can access many of the same publicly traded companies that massive investment funds invest in. Same public market, very different resources. Way fewer boats sinking, hopefully. So no, I'm not a financial advisor. I'm barely a financially responsible cockroach. But now you understand more about the stock market than most people who talk about it confidently at parties. Which, coincidentally, is my entire brand. Stay confident, stay slightly wrong. See you next time.